The U.S. oil and gas sector is currently experiencing a record-breaking wave of mergers and acquisitions, with billions of dollars changing hands. What does this consolidation mean for the industry and global energy markets? In this video, we'll break down the latest M&A activity, key deals, and the potential long-term impacts on oil production and global prices. In 2023, the U.S. oil and gas industry saw a historic $234 billion in M&A activity. Among the largest deals, ExxonMobil acquired Pioneer Natural Resources for $60 billion, and Chevron merged with Hess in a $53 billion deal. The final quarter alone set a new record, with deal values reaching $144 billion, the highest ever recorded. So far in 2024, the second quarter alone witnessed $30.2 billion in M&A deals. Key deals included ConocoPhillips and Marathon Oil's $22.5 billion acquisition and Crescent Energy and SilverBow Resources' $2.1 billion deal. The third quarter kicked off with Devon Energy acquiring Grayson Mills for $5 billion, and Vital Energy and Northern Oil and Gas acquiring Point Energy Partners for $1.1 billion. While the U.S. market boomed, global oil and gas M&A activity fell by 20% year-on-year in the second quarter of 2024, totaling $86 billion. Out of 17 global megadeals in the second quarter of 2024, 13 were in the U.S., highlighting the country's outsized role in current M&A activity. In early 2024, the Permian and adjacent Midland Basin accounted for half of all M&A activity. By the second quarter, deals in the Permian and Midland dropped to just 7% of the total, indicating a saturation of opportunities. Companies are now turning to other basins like the Eagle Ford and the Uinta Basin for growth. These areas are becoming attractive as companies seek new acreage and potential production increases. The U.S. has become the epicenter of oil and gas mergers and acquisitions, with companies leveraging strong financial positions and facing less regulatory pressure compared to other regions, particularly Europe. In contrast, M&A activity outside the U.S. is sluggish, with global deals declining and companies grappling with tighter regulations and economic uncertainty. Why does the U.S. lead? Well, U.S. companies have more access to capital and are actively seeking to expand their portfolios. Despite growing pressure, the U.S. regulatory environment remains more favorable for M&A than in other major markets. As the number of players shrinks, production will likely become more controlled and strategic, similar to OPEC's influence on global oil supply. Fewer small independents. Smaller, debt-laden independents will play a smaller role, reducing the previous drill at will approach that characterized the U.S. shale boom. Global market implications. With a more consolidated industry, U.S. shale could have a greater impact on international oil prices, positioning itself as a major influence similar to OPEC. Long-term outlook. As consolidation continues, the global oil market will need to adapt to a new reality where U.S. shale producers have more control over supply, potentially stabilizing prices at higher levels. In conclusion, the U.S. oil and gas industry's ongoing M&A spree is reshaping the domestic landscape and could have far-reaching implications for global markets. The move towards consolidation indicates a strategic shift towards more controlled production, with potential consequences for global oil prices. If you found this deep dive into the U.S. oil and gas M&A frenzy insightful, please like, share, and subscribe for more content on the energy sector and its impact on the global economy.